Hey, what's going on YouTube? We are going to go through Saia Inc., ticker symbol SAIA. This is a transportation company that operates in North America. And this particular company was brought to us by a current subscriber who wanted us to go through this one. So that's what we're going to do. Year to date, this company is down 6.5% over the course of 1 year, up 48%. And we can see here, after they reported earnings, we went from about 600, we'll call it $543 per share, down to, by the time it's settled, about $400 per share. So significant price drop. So this could be a potential buying opportunity on Saia. We'll get to that once we get over to the valuation spreadsheet and figure out the fair market value. So on their earnings, they missed on top and bottom line. Revenue missed slightly, which then EPS also missed slightly. And going forward, we can see EPS revisions. There's 15 revisions, all to the downward direction, but they're still seeing EPS estimate of 388, which is a pretty nice increase quarter over quarter there. And revenue also seeing about a $50 million increase quarter over quarter as well, for at least estimates. So in the earnings call, there was about 3 key points that I thought were worth sharing, and we can see the CFO, Doug, here mentioned that instead of interest income and all the cash that they've been sitting on, they're going to use their revolver a little bit this year and have some debt for the first time in a while, which once we get to the 10Q, I think that's a pretty smart decision. And point number 2 is they've added 20 new facilities in the last 2 years. So obviously that's good. They're continuing to see growth, and they're expanding, and that means more revenues. And then they also anticipate capital expenditures for 24 to be approximately $1 billion. Again, another thing we will see once we get over to the 10Q, we'll see that they are definitely investing heavily into capital expenditures currently. So over to the financials, this is the one we're going to see how this company's performed historically. And we come over here to our charts. We can see our revenue, gross profit, net income chart. We can see revenue continues to grow year over year at a pretty nice rate. We got gross profit not really doing the same thing here, kind of seeing it not growing at a great rate. We'd like to see it grow a little bit better than that. But we do see net incomes, though, are actually doing better than gross profit, and net incomes continue to grow year over year as well. And we come down here to margins. We see gross margins rose up, dipped, and haven't quite recovered. They just have not gotten back to these low 20 margins. They've kind of fallen back off a little bit. Looking like they're in the range of 16 to 20% range currently, based on what we're seeing. It looks like they might end up in that range of 16 to 20%. And at net margins, last quarter sitting at 12%, just shy of where they have been historically, of all-time highs at 12.8%. Return on invested capital, 16.3%. PE ratio today sitting at about a 30 PE, and we can see historically kind of on the rich side. Cash to short-term debt, we can see this blue bars is cash. Cash was growing, and then cash completely disappeared in the trailing 12 months. And debts did not disappear. So we want to figure out where all that cash went. And we can see cash to short-term or cash to total debt. Same story here. Cash was growing, debt's also growing, but all of a sudden cash disappeared. So definitely we want to know the answer to that right there. Then we come over here to net income to free cash flow. Company produces decent net incomes and did produce positive cash flows, and they were doing it consistently at a nice growth. But as of recently, we can see trailing 12 months cash flows negative, sharply negative. Another question that we want to know the answer to. And we can see here, clear picture, free cash flows positive to negative. Capital expenditures, though, they just got done mentioning that in fiscal year 24, they're going to have $1 million, or expect to spend $1 billion in capital expenditures, and they've started. We can see that right here. 23, they did a total of $440 million in total cash flows. And spoiler alert, they have already done that in the first quarter of this year. And we can see share count dilution sitting flat, sitting at about 27 million shares outstanding. So over to our balance sheet, we have quarter over quarter. This time last quarter, we were sitting at about $300 million in cash, and now we're sitting on about $12 million in total cash. So not very strong there. need more cash, I believe, to operate this business. And we come down here. We got current liabilities. Current liabilities of $338 million and only $12 million in cash. That is not good. That is a very weak balance sheet currently. Then we come down here to their income statement. Revenue year over year, nice growth. Went from 660 up to $755 million in operating revenue. Then come down here to operating expenses, up slightly, about $43 million. To be expected if you're growing and opening up more facilities. You're going to need truck drivers, people to operate those facilities as well. So you're going to see obviously increase in salaries, wages, and employee benefits and whatnot. So then come down here to operating income. We can see then positive $118 million in operating income. And then flow down here, we can see an income of $1 million from interest and non-operating expenses. So then we add that into our $118 million. We're sitting at about $119 million. Strip out taxes, net income of $91 million. Also, we do see shares slightly diluted, but very nominally. Went from 26,702 to 26,794. So not a very big dilution there. And then to our cash flow statement, we got $91 million in our net income. And then we have cash that flowed in and out of this business here. And we're left with about $106.5 million in net cash provided by operating activities. And then right here, we can see here's our capital expenditures of $457 million. So that's what they done in the first quarter. They did less than that all of last year at $440 million. So they've already exceeded their last year's capital expenditures. Obviously, they already gave us a heads up like, hey, we're going to spend $1 billion in CapEx this year. So if they plan on spending more in CapEx, they're not going to be positive free cash flows, at least for probably the next quarter or two, depending on how quickly they spend on cash or capital expenditures. So we should expect them to issue debt or get debt issued in this next quarter coming up to cover more future expenses. So probably going to impact the balance sheet, which is probably why we're seeing a bit of a hit to the stock price right now. Obviously, the capital expenditures are for good reason. That's to obviously grow the business and help increase overall revenues. So it's obviously going to impact the share price in the short term, but in the long term, it should help and grow this business. But overall, after we add and subtract all these numbers together, we're then are going to see a net decrease in cash and cash equivalents of $284 million. We had $296 million, which we are now left with a cash position of $12 million. So really would like to see that grow or at least get back to $300 plus million, at least enough to cover their short-term debts. That would be ideal, and slightly more than that would be better, but we'll have to see what they do in this most recent next quarter on the balance sheet side of things and also the capital expenditures to see how things are going. Right now, it looks bad, but it's for good reason. So this is kind of, I think, a short-term negative catalyst for this business until these balance sheets and the overall financials start to look a little bit better than where they're at right now. So now over to the comps. We're going to compare this to two other companies. We got XPO and Old Dominion Freight. And we come down here and compare all of the charts. We can see market cap. Old Dominion Freight has a pretty significant market cap in comparison. And we've got revenues. XPO, leader in revenues. And growth rates on the board here. Good growth on all three companies, but XPO has significantly more growth than the other two. And we come down to margins. And XPO's margins just are not that great in comparison. Old Dominion Freight, though, their margins appear to be pretty fantastic. And Saia margins, we already went through them. They're decent. They're at near where they've been historically. So we know that if they're going to grow, they're not going to grow at some crazy rate. So that these margins are about or where they've been historically as well. And then we know free cash flows on Saia. They've done positive cash flows. They've done consistently at positive cash flows. Obviously, we know they're investing into their business right now, so we're not seeing positive cash flows at the current time. But XPO, though, based on their margins at 3%, net profit margins, to see negative free cash flows as well on that, I think they need to do a lot of work to increase their margins to get into positive cash flow territories. And then we got Old Dominion Freight, positive free cash flows there. Return on invested capital, 16%, 27% Old Dominion Freight. PE ratios across the board here, Old Dominion and Saia or pretty close to the same PE ratio there. I would not pay a 56 multiple for XPO. I'd rather invest into one of these other two businesses based on the PE ratio that we're seeing and based on the margins that we're also seeing. Old Dominion Freight actually looks a little more attractive, based on these charts here. Obviously, we haven't gone over Old Dominion whatsoever, but just based on what we're seeing here, Old Dominion definitely is interesting. And we can see earnings yield sitting at about 3% between Saia and Old Dominion as well. Now over to the calculator spreadsheet, figure out what this thing is worth. So P&L's valuation, $246 per share. Multiples comparison, 605.50. Price to book, it's in line with its 5-year average of price to book. And PEG ratio, we are looking at a forward-looking PEG of about 2. So kind of telling us we are about fairly valued forward-looking. Graham's valuation, $508 per share. And discounted cash flow valuation, we know that they are currently negative free cash flows, so we're not going to use the DCF price per share calculator. So we will not include that into today's valuation. We have 3 sources of an EPS growth rate for an average of about 16.6. We get to then double our current EPS 2.3 times, which then gives us a future EPS of about 57 for a fair value today of $473.45 per share. Over to the final valuation. So currently trading at $407-ish per share there. We have a fair market value of $458 per share, 30% margin of safety, be about 321. Analysts have a price target of $507 per share on this one. So one thing we'll do real quick is we'll plug in forward-looking numbers. We know EPS forward is 15 and PE ratio is 27. So that adjusts a few of our calculators here. Our future EPS down here as well, slightly, we'll just plug in 62 there. So then that gives us a fair market value forward-looking basis in 12 months at $498, 30% margin of safety, about 350. Obviously, analyst price target unchanged there. Now over to the stock chart. So we know our fair market value forward-looking is about, or 30% margin of safety is about $350 per share. Our fair market value is sitting up here about $500-ish per share. So that would be our range between these two blue lines is 30% market safety to fair market value. And we can see here's where we're trading about $408 per share. We're trading within some junk here, but there appears to be some sort of support range down at 350. I think that would be a fantastic buying opportunity on this one. I think you could maybe step in a little bit on here at this range, at this current price point. Maybe not 100%, maybe see if this thing doesn't roll over a little bit and wait and see what next quarterly earnings are going to be like. Maybe balance sheet, got a lot better. Things financially are looking cleaner and safer as well. So I think I would kind of sort of maybe wait and see on this one. But overall, based on valuations and based on the financials, definitely some work to do, but I definitely think this is something that could be worthy of putting some money into. But that is it for Saia Trucking, or Saia Inc. in this case. If you found value in this video, drop a like, subscribe, comment, and back later with another stock analysis video.